For years, dealerships took advantage of buyers, charging outrageous markups on trucks and SUVs. But now, that greed is backfiring. Big time. Repo lots are overflowing, automakers are cutting production, and some dealerships are so desperate they're turning away new deliveries. So what does this mean for you? Should you buy now? Or wait for even bigger price drop? And are dealerships finally paying the price for their greed? Stick with me, because I'm about to break down the shocking truth about the car market collapse. And trust me, you won't believe what's coming next. What's happening? Car prices have skyrocketed beyond affordability, creating a crisis that few saw coming. What was once a booming industry is now facing serious trouble. SUVs and trucks, which dominated the market for years, are sitting unsold on dealership lots. Buyers who were once willing to pay inflated prices are now backing off, unable or unwilling to take on massive monthly payments. The reality is simple. People have reached their financial limit, and dealerships are feeling the pressure. With inventory piling up and buyers refusing to spend, the auto industry is teetering on the edge of a major collapse. What seemed like an unstoppable market is now cracking under its own weight. But here's the thing, this wasn't just an unfortunate turn of events. The price hikes that drove buyers away weren't just the result of inflation or supply chain issues. Dealerships played a massive role in creating this mess, and now they're paying the price. But the price hikes weren't just a coincidence. Dealerships played a big role in making this mess worse. How greedy dealerships created this problem. At the height of the pandemic, dealerships saw an opportunity to maximize profits, with supply chain disruptions limiting vehicle production. They capitalized on scarcity. Suddenly, cars that would have sold for a fair price were being marked up by $10,000, $20,000, even $30,000 over the manufacturer's suggested retail price. Desperate buyers, many of whom needed reliable transportation, had little choice but to pay these inflated prices. Dealerships knew they had control. They used high-pressure sales tactics to convince customers that if they didn't buy now, they might not get another chance. Buyers who walked into showrooms expecting to negotiate were instead met with take-it-or-leave-it pricing, forcing them into unfavorable deals. Some even turned to extended loan terms, 72 months, 84 months, or even longer, to make their payments seem manageable. Fast forward to today, and those buyers are now trapped in financial nightmares. Vehicles they purchased for tens of thousands of dollars over retail price have lost value rapidly, putting them deep underwater on their loan. Some buyers now owe more on their cars than they are worth, making it nearly impossible to sell or trade them without taking a massive financial hit. The result: a car market full of frustrated consumers who feel cheated and refuse to buy again anytime soon. Dealerships may have enjoyed short-term profits, but their greed is coming back to haunt them. Buyers are angry, cautious, and unwilling to overpay again. And now dealerships are sitting on a mountain of unsold inventory with no easy way out. This isn't just about dealerships losing money. It's affecting factory workers, supply chain employees, and countless others who rely on the auto industry for their livelihoods. The industry is heading toward a potential economic downturn, and unless something changes, the worst may still be ahead. But the real bombshell is that even when prices drop, many buyers simply can't afford new cars anymore. The auto loan crisis is getting worse. Even if dealerships slash prices to attract buyers, many people simply can't afford a new car anymore. Interest rates have climbed to record highs, making car loans incredibly expensive. For many Americans, financing a new car is no longer a realistic option. Here's the shocking truth: 1 in 4 car owners is now underwater on their auto loan. This means they owe more than what their vehicle is worth, leaving them stuck in a financial trap. For some, even selling their car wouldn't be enough to escape their debt. And it gets worse. Repossessions have surged by over 20% in the past year alone. People who signed up for massive car loans are now defaulting, unable to keep up with the high monthly payments. Banks and lenders are struggling to recover vehicles fast enough, with some repo companies backlogged for months. The auto loan crisis is setting up a dangerous domino effect. As more people default, banks will tighten lending standards, making it even harder for new buyers to qualify for car loans. This will lead to even lower demand for new vehicles, further pushing dealerships into financial distress. Many experts are now predicting that a major auto loan collapse could be on the horizon. If repossessions continue to climb and more borrowers fall behind, it could trigger a credit crisis similar to what happened in the housing market crash years ago. If that happens, the entire auto industry could be in serious trouble. With buyers walking away, dealers are scrambling to win them back. But their desperate tactics might not be enough. Massive discounts aren't enough. Car dealerships are scrambling to offload unsold inventory, slashing prices by $10,000 to $20,000 on popular SUVs and trucks. Vehicles that were once impossible to find without paying a steep markup are now sitting untouched, even with deep discounts. For years, dealers leveraged supply shortages to inflate prices, assuming demand would remain strong. Now, reality is hitting hard. Consumers are feeling the weight of sky-high interest rates, making financing even discounted cars an expensive burden. The average new vehicle price remains over $48,000, and with interest rates often exceeding 7%, monthly payments are still unaffordable for most buyers. In response, some dealerships are offering 0% financing, hoping to lure hesitant buyers back. But even this strategy isn't working. 0% financing is often paired with shorter loan terms or higher upfront costs, negating the savings. Buyers, already wary of dealership tactics, aren't taking the bait. The desperation is obvious, but instead of simply lowering prices further, many dealerships are resorting to shady tricks to keep their profits intact. So, what are dealers doing to fix this mess? Well, some of their tactics are downright shady. Sneaky tactics dealers are using to trick buyers, with sales slowing down. Dealerships are deploying aggressive and deceptive strategies to make their offers seem better than they are. One of the most common tactics, extending loan terms to 84 months, or even longer, to make monthly payments appear lower. At first glance, a longer loan term might seem like a great way to afford a new car. But in reality, buyers end up paying thousands more in interest, often finding themselves in negative equity for most of the loan's duration. By the time they are ready to trade in or sell, their car is worth far less than what they still owe. Another trick is the illusion of huge discounts. Some dealers are inflating sticker prices only to slash them later, making it seem like buyers are getting a great deal. But in many cases, the final sale price is still higher than pre-pandemic levels, meaning the discount is nothing more than smoke and mirrors. Then there are the pressure tactics. Many dealerships push unnecessary add-ons like extended warranties, paint protection, or nitrogen-filled tires, all with massive markups. Salespeople present these add-ons as mandatory or claim they are already included in the purchase price, making it harder for buyers to refuse. Buyers are also encountering hidden fees disguised as market adjustments, dealer prep fees, or protection packages. These fees add thousands of dollars to the final price and are often buried in paperwork to avoid detection. But here's the catch: buyers aren't falling for it anymore. Consumer behavior is changing fast. The rise of buyer resistance. The car market is shifting, and consumers are no longer rushing to dealerships the way they used to. Instead of giving in to dealership tactics, many buyers are choosing to wait, holding on to their current vehicles longer than ever before. The average age of vehicles on the road today is over 12 years, a record high, with modern cars lasting longer and repair costs still cheaper than new car payments. Many drivers are delaying their next purchase indefinitely. Financing rates have also played a major role in this trend. With interest rates on auto loans remaining high, monthly payments for new vehicles are out of reach for many consumers. Instead of taking on expensive debt, buyers are opting to keep their existing cars running with routine maintenance and repairs. Another major shift is the declining value of used cars. After years of inflated pricing, used car prices are finally dropping. In many cases, a slightly used vehicle costs significantly less than a new one, even with discounts on the latter. Buyers who need a car are increasingly choosing used over new, further hurting dealership sales. Leasing has also become a less attractive option as monthly rates soar, leading consumers to consider outright purchases or holding off altogether. Even those who want a new car are waiting for the market to collapse completely. With inventory piling up, Many experts believe that even bigger discounts are on the horizon. Smart buyers know that dealerships will be forced to cut prices even more in the coming months to clear out old inventory before new models arrive. Additionally, more consumers are exploring direct-to-consumer options from manufacturers, avoiding dealership markups entirely. This newfound buyer resistance has put dealerships in a difficult position. They can either drop prices to realistic levels or continue struggling to move inventory. The days of unchecked dealership markups and easy sales are quickly fading. And it's not just individual buyers making moves. Car manufacturers are also stepping in, adjusting production levels and offering incentives to drive demand back up. Will car companies cut out dealerships? As dealerships continue to struggle, some automakers are taking matters into their own hands, rethinking the traditional dealership model and looking at direct-to-consumer sales. Tesla pioneered this approach, selling its vehicles directly to customers without a dealership middleman. This model not only keeps prices more predictable, but also eliminates markups and aggressive sales tactics. Now, other automakers are taking notice. Some manufacturers have already begun penalizing dealerships that engage in excessive price gouging. Ford and General Motors, for example, have warned dealers against unfair markups, threatening to limit their future inventory allocations. Toyota has also expressed concerns over dealership pricing tactics, though it has yet to take significant action. Beyond just price controls, the biggest shift could come from more brands adopting direct sales models. Companies like Rivian and Lucid already follow Tesla's approach, and legacy automakers may soon follow suit. If this trend continues, dealerships as we know them could become obsolete, replaced by online orders and manufacturer-owned stores. For buyers, this could be a game changer. No more hidden fees, deceptive markups, or high-pressure sales tactics. Just transparent pricing and direct purchases. Of course, dealerships won't go down without a fight. Many states have laws protecting dealership networks, preventing automakers from selling directly to consumers. But as buyer frustration grows and dealership inventories remain stagnant, the pressure for change is mounting. If more automakers follow Tesla's lead, the traditional dealership model may not survive the next decade. But that's not the only change coming. Entire segments of the auto industry are collapsing. The EV hype has crashed. Not long ago, automakers pushed electric vehicles as the future of the industry. They invested billions into research, production, and marketing, believing that consumers would eagerly adopt battery-powered cars. For a while, that strategy seemed to work. Early adopters and government incentives helped boost electric vehicle sales, and companies like Tesla became household names. But now the hype is fading fast. Instead of selling out, electric vehicles are piling up on dealership lots. Prices, once inflated by high demand, are now plummeting. Yet buyers are still hesitant. Why? Because the reality of owning an electric vehicle is far less appealing than the industry led consumers to believe. One of the biggest barriers to widespread adoption is charging infrastructure. Despite years of promises, the charging network remains inconsistent and unreliable. Many regions still lack fast charging stations, and in colder climates, electric vehicle batteries struggle with efficiency. Long charging times and limited range make many potential buyers think twice, especially those who rely on their vehicles for long commutes or road trips. Then there's the cost factor. Even with price cuts and government incentives, electric vehicles remain far more expensive than their gas-powered counterparts. While they promise lower maintenance costs in the long run, the high upfront price tag and uncertainty about battery longevity makes many consumers hesitant to commit. Automakers bet big on electric vehicles, but now they are sitting on massive inventories they cannot move. Some manufacturers are even scaling back production to avoid deeper losses. If demand does not pick up soon, electric vehicles could become a financial disaster for the industry. And it is not just electric vehicles that are struggling. Traditional SUVs and trucks are also losing their grip on the market. Why SUVs are no longer selling like before? Automakers prioritized SUVs over sedans, knowing they could charge higher prices and make larger profits per unit. Consumers love them for their versatility, size, and commanding road presence. But now something has changed. Even though SUVs remain the most popular segment, they are starting to lose traction, and the reasons are clear. First and foremost, prices have skyrocketed. The days of finding a brand new mid-size SUV for a reasonable price are long gone. Many full-size models now cost over $80,000, with luxury trims pushing past $100,000. Even more affordable options have seen steep price increases, leaving budget-conscious buyers with fewer choices. But it is not just the sticker price. Financing has become a nightmare. With interest rates rising, monthly payments on new SUVs have become unaffordable for many households. Leasing, once an alternative for those who could not finance a full purchase, has also become less attractive due to high residual values and limited incentives. Another major factor in the decline of SUV sales is the growing demand for efficiency. Large gas-guzzling SUVs are becoming less practical as fuel prices fluctuate. Consumers are starting to prioritize smaller, more fuel-efficient vehicles that still offer versatility but without the extreme costs. This shift is especially evident among younger buyers, who are less interested in oversized, high-maintenance vehicles and more focused on affordability and sustainability. As a result, automakers are being forced to rethink their approach, knowing that SUV dominance may not last forever. This shift in consumer preferences could lead to a surprising comeback for smaller, simpler, and more affordable vehicles. Are cheap, simple cars making a comeback? After years of automakers pushing larger, more expensive vehicles, there are signs that simpler, more affordable cars may be making a return. Buyers are fed up with inflated prices, excessive technology, and expensive repairs. Instead, many are looking for reliable, no-frills transportation that gets them from point A to point B without breaking the bank. Compact, fuel-efficient sedans and hatchbacks, which were once seen as outdated, are gaining popularity again. Some buyers are turning to older used cars rather than paying a premium for new models packed with unnecessary features. Meanwhile, some automakers are considering bringing back basic, budget-friendly models to meet growing demand. One of the biggest drivers of this trend is the rising cost of vehicle ownership. Insurance rates have increased significantly, and repairs for high-tech cars are becoming more expensive than ever. Many consumers are realizing that they do not need massive infotainment screens, complex safety systems, and luxury features. They just want a dependable car at a reasonable price. Toyota and Honda, for example, have seen continued success with their compact sedan offerings, proving that there is still demand for simple, fuel-efficient vehicles. Meanwhile, brands like Hyundai and Kia are investing in small, affordable hybrids, targeting budget-conscious buyers who want efficiency without the price tag of a full electric vehicle. If this trend continues, automakers may have no choice but to shift their focus back to affordability. The question is, will they actually listen to what consumers want? But before that shift happens, dealerships still need to deal with their biggest problem yet: unsold inventory stacking up at an alarming rate. Will the auto market finally crash in 2025? The auto market is at a tipping point, and the next 6 to 12 months will determine whether a full-blown crash is coming. Right now, dealerships are drowning in unsold inventory, and sales are not recovering fast enough to balance it out. Many dealerships are reporting record levels of stock, with overflow lots filled with vehicles that are not moving. This problem is not limited to just electric vehicles or SUVs. It is affecting the entire industry. From luxury cars to economy models, inventory is piling up, while buyers are holding off on purchases. Some experts believe this situation could trigger a wave of dealership closures. Smaller, independent dealers who rely on quick turnover may not survive if sales remain stagnant. Even larger dealership chains are struggling to maintain profitability, forcing them to offer massive discounts and incentives just to get vehicles off their lots. The biggest challenge automakers face is the disconnect between pricing and consumer affordability. Prices remain high, financing options are less attractive, and many potential buyers simply cannot afford to take on new car payments. Unless dealerships drastically cut prices and automakers adjust their production strategies, the industry is at serious risk of a major collapse. For buyers, however, this could be a golden opportunity. If dealerships become desperate enough, they may be forced to slash prices, offer better financing options, and get more aggressive with trade-in deals. Those who have been waiting for prices to drop may finally have their chance to negotiate and buy at a significant discount. As we head into the next phase of this crisis, buyers need to pay close attention to the market trends because the best deals may be just around the corner. The best time to buy a car in 2025. If you are in the market for a new vehicle, patience could save you thousands of dollars. The car industry is currently experiencing a massive inventory overflow, forcing dealerships to rethink their pricing strategies. While many buyers are still hesitant due to high interest rates and inflated prices, those who wait just a little longer could score once-in-a-decade deals. The best time to buy a car in 2025 will likely be summer through early fall. Historically, dealerships begin aggressively discounting vehicles between May and September, as they scramble to clear out old stock before the new model year arrives. This means that consumers who hold off on purchasing until the August-September window may have access to the deepest price cuts of the year. Dealerships are also struggling with high inventory costs, making them even more desperate to offload vehicles sitting on their lots. Many brands are offering manufacturer-backed incentives, including 0% financing, cashback offers, and special lease deals. However, not all deals are created equal, and buyers must be strategic to maximize their savings. Timing is everything. End-of-quarter and end-of-year sales events can also be prime opportunities for deals, as dealerships rush to meet sales quotas. Additionally, shopping for a car toward the end of the month often gives buyers more leverage, since salespeople are trying to hit their targets. The best discounts will appear between summer and early fall, with the most aggressive deals happening in August and September. If you can wait, hold off until then to make your purchase. But even with price cuts, you still need to avoid dealership tricks. How to negotiate the best deal. A price drop does not automatically mean you are getting the best deal. Dealerships are masters at playing the numbers game, making it essential for buyers to know how to negotiate. Walking into a dealership unprepared could still result in paying more than you should. The most important rule is never accept the first offer. Dealers are trained to start high, assuming most buyers will not push back. If you negotiate firmly, they will almost always lower the price. Remember, dealerships need to sell their excess inventory, and their biggest fear is watching a potential buyer walk away. Another powerful negotiation tool is leveraging unsold inventory. When you visit a dealership, take note of how many of the same model are sitting on the lot. If a vehicle has been sitting for months, the dealership is losing money just by keeping it there. That gives you an advantage. They are desperate to sell. Additionally, always focus on the total price of the car, not just the monthly payment. Many dealerships manipulate financing terms to make a monthly payment look more affordable, while hiding extra costs in interest and fees. Make sure to negotiate the final out-the-door price, including all taxes and fees, to avoid paying more in the long run. If you are trading in a vehicle, do not accept the first trade-in offer without doing your research. Dealerships often lowball trade-in values to pad their profits. Before you go to a dealership, check the value of your car on multiple platforms and get quotes from multiple dealerships. This allows you to use competing offers as leverage. The power is in your hands. Negotiate aggressively, use unsold inventory as leverage, and focus on the total cost, not the monthly payment, to get the best deal. And if you really want to avoid dealership headaches, there's one more option: skipping the dealership altogether. A growing number of buyers have completely bypassed traditional dealerships in favor of direct-to-consumer car purchases. And for good reason, many automakers now offer direct factory orders, allowing buyers to avoid dealer markups and hidden fees. Tesla pioneered this model, selling cars directly to consumers without dealerships acting as middlemen. Other manufacturers are now following suit, offering online purchasing options that let buyers customize their vehicle and lock in factory pricing. This means no dealership games, no unnecessary add-ons, and no inflated pricing. Some brands are even experimenting with subscription-based models and fixed pricing, which could reshape the way people buy cars. Additionally, buyers who order directly can often save thousands compared to those purchasing from a dealership. However, ordering from the factory does have a downside. It typically requires a longer wait time. In some cases, buyers may have to wait 3 to 6 months for delivery. If you are in no rush, this could be an excellent way to save money while avoiding the hassle of dealer negotiations. For those who still want a new car without waiting months, many dealerships list their inventory online with pre-negotiated prices. Shopping online first can help buyers compare offers and identify which dealerships are willing to discount the most. If you want to avoid dealerships, consider ordering directly from the manufacturer. It may take longer, but it can save you thousands and eliminate the stress of negotiation. But for now, if you're going to a dealership, there's one final tip you need to remember. Now we want to hear from you. Do you think dealerships will survive this crash? Or is the industry doomed? Drop your thoughts in the comments below.